Be with someone who is loyal, brings you happiness, always by your side, if you treat it right and nurture it wisely. Uh-uh. आप किसके बारे में सोच रहे थे? I was talking about money and not someone who wipes it out. Rather than wiping it out, we will be talking about compounding money. And who better to learn it from than the ones who really compounded their wealth? Me, Parva, along with Tisha, Rishali, Kamal, and Purva, we are students of Finacle Institute and currently pursuing FinBridge program. In this video, we are going to present the learnings we got from reading the book Masterclass with Super Investors, written by Vishal Mittal and Saurabh Basrar. Our first video will be on learnings from Mr. Kenneth Andrade in this series. So let's start. Mr. Kenneth Andrade is the founder and CIO of Old Bridge Capital Management and manages the investment process and ideation there. He has 15 years of track record of managing India's most successful equity funds. Throughout the course of this video, we will be looking at all the aspects that he talks about in the book Masterclass. And now I will let Kamal speak of us ahead.
Now here I want to talk about a brief introduction and experiences of Kenneth sir. He is a 51-year-old cyclical investor born in Hyderabad, done his BCom degree from Narsimunji College. His capital market journey started from Capital Market magazine to IDFC Asset Management, from where he started his own company, Old Bridge Capital, where he became CEO and the CIO of the company. He is more of a balanced focused investor who looks in improving capital efficiency and tends to catch the trough in an industry. We are going to discuss these in much more detail into coming slides. But for now, I want to invite Tisa for the further explanation.
So let's take a look on the matrix through which Kenneth sir filters companies. Now, first is increasing market share. Now, market share is the number of customer the company is catering to. So, if there is an increase in that, that means the company is able to provide its products and services to a larger number of audience that might probably increase their revenue and profit. Coming to the next one is avoiding levered businesses. Generally, Kenneth sir prefers businesses who do not have much debt on their business. Now, the next three, that is capital efficiency, reasonable valuation, and shrinking balance sheet size, will be explained in the upcoming slides. Coming on to his initial investment philosophy, he says that he really didn't had any investment philosophy for 10 years, but he had great knowledge about the sector he studies. For instance, he mentions that he could tell the cost of average per spindle of any random textile company even when woken up at midnight. So he knew every small detail about the sector he studied. Now, there is a qualitative factor, management. He considers a management good when there is not much of the capex done on the peak of the cycle. So low capital allocation on the peak of the cycle will result into longevity of the business. Now, Kenneth sir isn't much focused about the earnings of the business as he is a balance sheet focused investor. So a quantitative metrics which he used to evaluate companies is capital efficiency from the balance sheet. Wondering how capital efficiency is judged? No worries, we've got you covered. Now here, capital efficiency is judged through market dominance and execution. Now, market dominance is determined by higher sales. Higher sales generally tends to bring higher profits, but here profits are industry driven. So when a business is in an upcycle, their profits tend to be higher. So the very important matrix which is left to judge the capital allocation is the execution. That is the decisions of the management how to employ capital on the peak of the cycle. Generally, on the peak of the cycle, low capital should be employed. Now, does it sound counterintuitive to you that when a business is in an upcycle, shouldn't it increase its capacities, produce more, sell more and earn more money. So we will understand this through business cycle. Now, first things first, what is a business cycle? Now, business cycle is the expansion phase, which is almost this, and the contraction phase through which a business goes through. Now, the top of the cycle is considered as peak and the bottom of the cycle is considered as trough. Now, these are some of the characteristic of peaks and troughs which we will understand through a dummy example. There is a dummy example about how a business operates or how a business goes through a cycle. Now, these numbers are given for the reference from the previous slide. Now, when a company is in an expansion phase, generally their revenues and profits tend to be increasing. Their realizations are also good. Now, attracted by this increasing revenue and profits, competition is attracted. Many new people are attracted and they enter the market. Now, when they enter the market, due to increased competition, supply will increase than demand, and thus the realizations will start dropping. Also, the existing companies will extrapolate their profit. That is, they will think that they have earned a good chunk of money in the past 2 to 3 years, and they will anticipate to earn more than that in the upcoming time. So, what they will do is they will take debt and increase their gross block. Now, gross block is the fixed assets through which the company is manufacturing the products. Now, this scenario generally is applied to asset intensive businesses, might not apply to every other business where their major costs are fixed. Now, when they slowly and gradually increase their capacities due to increased competitions, even they might not be able to operate at higher capacity utilization. Now, further, what will happen is slowly the revenues will start falling. At the peak of the cycle, the revenue is maximum. Their PAT margin is maximum. Their ROE is maximum. But when the cycle will turn, slowly and gradually, their revenue will fall. Their ROE will fall. The PAT will fall. The ROE will fall. Now, what happens is many of the companies, they take debt, so their finance cost is also increased. Now, they are not able to earn that much revenue, so they are not able to survive the debt they took. And when they are not able to service the debt, generally bankruptcies happen and consolidation happen. Smaller entities get merged with the bigger players. So then comes the trough of the cycle. Now, after this trough phase, again, the same thing will happen. The realizations will slowly start increasing. The revenue will slowly start increasing. PAT will start increasing. And thus, this is how businesses goes in a cycle. Now, here we can see that the ROE from positive number literally went to a negative. So what Kenneth sir says is one should be able to identify when this trough of the businesses is achieved. It's not necessary that you get it at the extreme tough, but even if you are able to get it at the almost trough portion like here, then you are tend to make good returns from that. Because if one buys, here is the lowest possible valuation of a company. If you buy here and even if you sell here or here, you are going to make it. You will make good returns. Not necessary to sell it at this peak. Now, during the peak, supply starts being greater than the demand and people start leveraging and creating more capacities. And during the troughs, there are low profits with low ROCEs and low ROEs, and also consolidation have happened. Now we can see here what an ideal business cycle looks like. At the trough, generally, there is a lack of capital. So what businesses do is they try and use it as efficiently as they can and start generating good ROEs. Now, higher ROEs, they will start earning good, their revenue will be increasing. What they do is they start extrapolating the demand and their profits. Now, they create capacities through debt, and sometimes if they are not able to service their debt, they will consolidate and realizations to decrease due to increase in the supply. Now here, one can observe that the EBITDA margins of the company is relatively stable and PAT is very volatile in nature. So that is why we can value these companies through EBITDA because they are less volatile than PAT. So rather than using PE, we can use a matrix like EV by EBITDA, which will be explained to you by Purva in the valuation matrix.
So now let's look at some valuation matrix that Kenneth sir has explained. So we first have EV by EBITDA. So let me explain what is EV by EBITDA. It is very similar to the ratio price to earnings. So we know that price is the current market price, which is calculated from market cap divided by number of shares, right? And earnings is the EPS, that is calculated from PAT divided by number of shares, right? So let me take back to the slide which Tisha just explained. So here we see that PAT is really very volatile. It becomes negative and then comes back to its normal levels. So when we have to calculate PE for such durations, we are left with negative EPS, which makes the ratio undefined. So we look for some other metrics that are stable and could give a better picture to us. So we are left with EBITDA and EBIT. So EBITDA is generally taken as the measure because depreciation costs for asset-heavy businesses are really a big deal because they have a greater depreciation cost. You must be convinced for the metric EBITDA we have taken for the ratio. So you may ask why EV? So EBITDA are the profits which are attributable to both equity as well as debt holders. These profits are to be distributed among both. That is the reason why we take EBITDA as a measure to value asset-heavy businesses. Now we have EV by sales. Kenneth sir have made a statement that when EV by sales is 1 and PE is high around 20 to 30, the profitability has been compromised. So we have taken an example here. So here you see PE is 25, PAT margins as 4, and EV by sales as 1. Here we see that when PAT margins grow, PE becomes smaller and EV by sales has been constant over here. The difference between EV by sales and PE is decreasing with increasing PAT margins. That is what Kenneth sir has explained here, comparing EV by sales and PE. So now here we have an instance where Kenneth sir finds a company MRF whose EV was equal to gross profit. So here we can see that it was actually equal to its gross profit. Here, Kenneth sir wants to explain us that when such instances happen, which are really rare, but when this happened and the PAT margins of the business are high, these could be said as a valuation trough. Now we have an instance. Here, Kenneth sir made a statement that one might not get a company at the same price, but at the same valuation. So here we have explained this by an example where the price of the share has actually increased from 100 to 200, but the PE, that is the valuation at which we buy the company, has remained equal, where EPS has also increased.
Thank you, Purva. These are some key insights what we get by understanding Kenneth sir. First insight, yielding assets are better than momentum investing because in down cycles, these companies at least provide dividends. While in the momentum-driven companies, they may destroy your capital too during the downturn. Second insight we get, prediction of future growth or earnings are largely based on market sentiment. While cash flows are a better metric to judge, thus cash flows before profits. Third insight we get, Invest only in the industry you understand. If you are not invested in an industry and it does well, it does not mean you did not do well. Your returns have no correlation with the returns of industry you are not invested in. Fourth insight we get, a company does well when generally when an industry does well. Thus, a good business economics is more important than business management. Fifth insights we get, an investor should never invest in an industry he does not understand, because he would never be able to gauge if company's downfall is due to market sentiment or due to change in fundamentals. Sixth insight, disruptions in any industry creates opportunities to invest in companies who had already predicted the change in trends and had migrated in that direction. So now for further explanation of these topics, first I want to invite Parva to take the explanation forward.
So now we are going to talk about how value-driven investing is better than momentum-driven investing. Momentum-driven investing is an illusion for creating wealth, and not only it wipes out our gains, but also has the potential to destroy our capital. When we invest in a momentum-driven stock, we do not know when the rally will turn around. So we will accumulate some profits at first. As we can see in this example, the price of a particular stock went from 100 to 250 till its peak, but we won't be able to convert our paper profits to real profits. And at the end of the cycle, not only we lose all of our profits, but also our capital invested reduces to 50%. After that, we are going to talk about how Mr. Kenneth Andrade has a unique take on calculating returns, that is, after deducting unemployed cash on the books. As we can see in this example of dummy balance sheet, if we calculate ROCE of a business, which is NOPAT upon debt plus equity, if we consider cash on the books, we will see a suppressed ROC. But if we do not, we will be able to see a clearer picture of the business. That is because the cash on the books does not bring any growth or profits to the business. Going ahead, we are going to talk about how companies whose cost of capital is lower or subsidized by the government will have a lower asking rate of return. In this example, we can see there are two businesses, business A and business B, with same amount of debt of rupees 10 lakh and equity with the same amount of rate of interest. But company B has a 5 lakh rupees subsidy by the government. So they will have a expected ROC or rate of return lower than the other company. Going ahead, we are going to talk about how a company does not perform good in isolation. Generally, it is the entire ecosystem that does well. When a company does well, it is not the only one performing well. It is because the entire sector or the industry is doing really well. For example, in 1990, Hero Honda performed really well, but it wasn't the only automobile company. Its peers like Bajaj Auto and TVS Motors also did very well. So when an industry is an upcycle, the market leader will top the list. But when the industry is in a down cycle where companies file for bankruptcy and consolidations happen, a market leader will be able to sustain itself. Going ahead, I would like to hand it over to Rishali.
Hello again. Now let's look into the investment process of Kenneth sir. The first and very simple thing is the return filter. He expects double the return of the risk-free return. Wondering what a risk-free return is? It is the return we get by investing in government bonds or FDs. So now, of course, as we take greater risk by investing in equity markets, we expect a greater return. The next thing is idea generation. He gets his ideas by visiting companies, researching into the particular part of value chain which is making huge amount of money, subtle but and loss-making businesses. Now, quite a contradiction, right? Loss-making businesses. Businesses can make loss as they are a part of trough. When the cycle turns around, these businesses can get converted into profit-making businesses and at the present time are available at a really cheap valuation. Now, subtle but is further divided into many types, but the major two are product rotation and transition of data from balance sheet to P&L. Looking into product rotation, we should check the inventory turnover and channel stuffing. When the products are not sold to the end consumer, but the producers can show revenue by passing it directly from themselves to the wholesaler and to the retailers. This shows that the demand of product is not present. Talking about transition of data from balance sheet to P&L, we should check whether the inventory is getting converted into revenue and revenue further into profits. As a producer would pile up the inventory only when he expects higher demand, and this demand should transition into profits. Now, moving on to the portfolio structure, the first thing is allocation. He generally tries to limit his allocation to 6 to 7% at cost. When he finds a company for which he has great conviction of growth, he can extend his allocation to maximum 10%, but the minimum allocation of 3% generally remains the same. The next is risk management. Risk is calculated at the overlap of benchmark. That is, comparing the weightages of stock in the benchmark to the weightage of stock in the portfolio. Now, as we can see, we have changed our weightages compared to the benchmark, and the returns have changed significantly. It provides a great opportunity to generate alpha, but also has the risk underlying to underperform the benchmark. The next is the holding period. As he buys businesses at troughs, he has to take significant time for them to generate significant returns. But generally, these are stocks with a great fundamentals which provide dividends of dividend yields of 4 to 5%, which is enough to compensate for the delay in returns. The next is sell decision. He generally takes sell decisions at peak because after that there will come a downturn and he can lose his capital. When he finds a better company, when the business is taking huge debt or allocating huge capital, especially at the time of peaks, when it loses market share or there is declining inventory turnover or interest coverage ratio. In case of interest coverage ratios, the company can be facing liquidity crunches which could lead to solvency issues in the future. The next is cash calls. High cash calls are generally considered to be a drag on the portfolio, but it does not matter when the invested capital is already doing well. The uninvested 10 to 15% cash on the portfolio is hedged and can be invested during crisis to generate further returns. So now let's move towards case studies.
Here we are going to discuss some of the investments made by Kenneth sir. These are some of the companies and the investment was made during these time periods. These are the major reasons behind which this investment was made by Kenneth sir. Like in Balrampur Chini, the market cap has compounded 20% trough to trough. So now you can able to imagine the growth, the kind of a growth the company has shown to its investor. In Bata India, the company was becoming a zero debt company from a highly leveraged entity. If the company is becoming a zero debt company, then the PAT margin of the company is going to increase with decreasing finance cost. It is ultimately going to impact wealth of the shareholders. In Glaxo Consumer, MRF Tires, and small cap investment, Kenneth has able to catch the trough of these companies. You also know that Kenneth sir is a cyclical investor. So these were some of the companies in which Kenneth sir has able to catch the trough. In Page Industries, Kaveri Seeds, Vardhaman Textiles, and West Coast Paper, into these companies the cash flows were good, because of which they didn't need to raise the equity from the market. Then also they did, and if they did, then also the valuation of the company was getting was very low. So these were the companies in which Kenneth sir has invested because of the cash flows. In Asian Paints, because of the short-term hike in crude prices, the EBITDA margin was reduced, because of short-term fluctuations into the crude oil prices, the market was predicting that this is going to be for a longer time. But when the crude oil price start decreasing, the EBITDA margin of the company will start rising again. So it will get followed by the valuation. So these were some of the investments made by Kenneth sir. And for the further explanation, I want to invite Tisha
So let us take a look on the Kotak MNC fund, which was managed by Kenneth sir. It was started in 2000 and it predominantly invested in multinational companies. He had 50 stocks to pick from, and in that, he had around 38% allocation into the pharmaceutical stocks. Now, a very basic checklist which he applies to all of his investments were market dominance, market share, growth, and reasonable PE. So now, these stocks, which were 38% of the portfolio, had a double-digit growth. They didn't had much of the huge capex, which we studied why it's not good. They had huge cash generation, high dividend payout, and more importantly, the growth was following to the bottom line. Now, what made this portfolio a success was that when these stocks started performing exceptionally well, he immediately flipped the portfolio, because now these stocks would start reaching a peak, and from there comes only a downturn. Similarly, Siemens and ABB, two were same stocks, same kind of stocks, which had a market cap of about 700 to 800 crores and were trading about 6 to 7 times cash flows. So they also were turned into winners. So the main thing which Kenneth sir tells us is when you buy them at low valuations, you are bound to generate good returns. So the right time is the key to success. And this fund ended up being in the top decile that year. So now we will take a look on the NBFC portfolio, which was created by Kenneth sir. We will start by taking a look how commercial banks are different from NBFC. In commercial bank, they get deposit from CASA, current account and saving account, which goes to 40%. So 40% of their borrowed money comes at 4% and the remaining at 8%. So their total cost of capital here is 6%. This situation is little different in NBFCs, where they don't have much of their CASAs, as it goes to only 10 to 15%. So their total cost of capital will be 8%. If a bank wants to earn a net interest margin of 2%, then they will have to lend it above 8%. But here, their cost of capital itself is 8%. So to earn an NIM of 2%, they will have to lend it more than 10%, making NBFCs a little bit riskier than the normal banks. Now, what Kenneth sir did was he invested his money in different monoline NBFCs. For example, here is in Bank ABC. This is a dummy example where they provide gold loan, personal loan, and mortgage loan. Their lending book consists 20% of gold loan, 60% of personal loan, and 20% of mortgage loan. Now, these loans are growing at 15%, 20%, 10% with an NPA of 1, 2, and 1% respectively. Now, what he did was he found same NBFCs in monoline businesses. Here, if for example, XYZ is the NBFC providing gold loan, it was growing at same 15% and 1% NPA. Now, together they were making and 15 to 16% ROE. So, if he had 100 rupees to invest in, he invested 20 in XYZ, 60 in DEF, and the remaining 20 in GHI. So the whole bank here doing the same function which these NBFCs cumulatively were doing, the whole bank was available at 3 PB, whereas these were trading at 1 PB. So here he actually synthesized and created a bank, which actually was not a bank, but by investing in different NBFCs, performing the same function of a bank, but at a lower valuation. So this is how we created good returns from it. So here we come to an end for this video. We hope you learned a lot of insightful things from Mr. Kenneth Andrade sir. In the next video of the series, we'll be presenting the learnings we jotted down from Mr. Govind Parekh.